Hello everyone, I am Kirtan, currently pursuing my MBA in Sri Venkateswara College of Engineering, Bangalore. Today I am going to give a presentation on swaps. The word swap literally means an exchange. In the language of finance, swap is a derivative contract in which two counterparties exchange certain benefits. The swap is a customized contract in the form of over-the-counter derivative. Swaps are non-standardized contracts that are traded over the counter, and also a swaps contract is a type of derivative based on the forward claims which can be understood from the following figure. A derivative contract are based on first one contingent claims, and under that options forward claims, and under that exchange traded futures and forwards and swaps. The counterparties agree to exchange one stream of cash flow against another stream. These streams are called the legs of swap. And timing of cash flow, the dates when the cash flows are to be made, and methods of calculation of cash flow amount. The swap agreement clearly specifies the way the cash flow are to be calculated. Because the swaps derivatives are OTC derivatives, there is also a risk of default counterparty, so that the corporation on the and the financial institution are primary users of the swap, and they dominate the swap market globally. And let us discuss about history of swap. The first interest rate swap occurred between IBM and World Bank in 1981. Swap have exploded popularity in 1987, and in 1987 the International Swaps and Derivatives Association reported that the swap market had a total national value of 865.6 billion. By mid 2006, the figure exceeded to 250 trillion, according to the Bank of International Statements, that more than the 15 times of the US public equity market. And let us know of the meaning of swaps. Private agreement or a contract between two parties to exchange a series of streams future cash flow according to a pre-arranged formula, where one party makes a payment based on the random outcome such as LIBOR variable payment, and other parties of a fixed payment. Swap means the exchange of something which is exchanged, and offer and exchange the sum of money at different rates. Private agreement between the counterparty exchange cash flow in the future according to pre-arranged formula. Agreement to the exchange sequence of cash flow for a set period of time. Agreement between the two companies or financial institutions to exchange cash flow in the future parties. A promise to make payments to one another on scheduled dates in future, and use different criteria or formulas to determine their respective payments cash flow. Characteristics of swaps. Characteristics of swaps are swap rate, fixed rate payer, floating rate payer, settlement dates, netting, termination date, and tenor. In Indian swap market at the present, only swaps are there, only types of rupees derivatives which can be traded in India. The main three types of swap instruments having specific criteria, plain vanilla interest rate swaps, currency swaps, GC linked swaps. And let us know about features of swap market. Features of swap markets are custom instruments, OTC market, intermediate facilitators banks, investment banks. These are the intermediate facilitators. And unregulated, and credit risk like default risk, dual coincidence of counterparties, general long-term contracts, terminations. And there are types of swaps. Let us know about types of swaps. Interest rate swaps, currency swaps, equity swaps, credit default swaps, commodity swaps. And let us know about currency swap. Currency swap is an over-the-counter derivative. It is a foreign exchange agreement. It involves the exchange of principal and interest payment on the loan or asset in the currency of principals and interest payment on the equivalent loan or an asset in the another currency. This is known as currency swap. Features of currency swap: foreign exchange agreement, over counter derivative, exchange of principal amount at the beginning and at the end of the swap contract. Types of currency swaps: fixed rate currency swap. Interest rates are fixed for both the parties. It is meant by fixed rate currency swap. Cross Cross currency swap: interest rate on the one leg is based on floating rate and interest rate on another leg is based on fixed rate. That fixed to float and float to fixed. Currency basis swap: interest on both the legs are based on the floating rates. Interest rate swaps, IRS, it also known as the coupon swap: exchange of two sets of interest flows based on the different interest rates in the same currency with no exchange of underlying national principal. They often exchange a fixed payment for a floating payment that is linked to an interest rate. These are very popular, highly liquid instruments and used to hedge interest rate risks. Equity swaps: it is an equity swap. At least in an equity swap, at least one party pays the equity return. The counterparty could pay an equity return is and a fixed interest rate of floating interest rate. Floating leg, usually pegged to a floating rate. Equity leg, based on the performance of either a share of a stock market index. Commodity swaps, agreement between the two counterparties to exchange the cash flow depending upon the price of a given commodity. Floating price is exchanged for a fixed price. One party pays fixed price while the other party floating price for the same commodity on the settlement date. Commodity swaps are used to lock in the price of a commodity. Valuation of swaps. Valuation of swaps means the value of the swap is in the net present value of all estimated future cash flows. A swap is worth zero when it is initiated. However, after this time its value may become positive or negative. There are two types of value swaps: using bond prices and portfolio of forward contracts. Termination of swaps. A party might want to terminate the swap before its formal expiration. This would be done in several ways, like one party pays a swap value to another party of offsetting contract or resale. Advantages of swaps: highly flexible. The main advantages are like highly flexible and can be customized to the parties. Cost of the transaction in the market is fairly low, and private transaction between two parties. Disadvantages of swaps: it requires to find a counterparty with opposite and matching need with willing accept the terms. Swap market is a liquid market and it requires to consent of counterparty to terminate. It is highly unregulated and suffers from unlimited potential credit risks. And let us know about risk associated with snaps. There are risks like interest rate risk, market risk, foreign currency exchange risk, default and credit risk, settlement risk, and so on.